Hello and welcome to this Unify webinar on Rethinking Impact to Finance the SDGs, a position paper that is in consultation mode at the moment and prepared by the UNEP Finance Initiative. This webinar will be presented to you by Eric Usher, Head of Unify, and Andrew Parry, Head of Sustainable Investing at Hermes Investment Manager, who is also co-chair of Unify's Positive Impact Initiative, as well as myself, Karine Ab, Program Lead for the Positive Impact Initiative at Unify. You're currently in mute as attendees. However, following Eric and Andrew's presentation for about 40 minutes in total, there'll be plenty of time to ask questions and give feedback. The way to do that is basically to ask a question via the questions section in the little dashboard you should have in your right-hand corner, or you can raise your hand and we will unmute you individually so you can ask your question. Please do note, though, that if you have joined via phone as opposed to an internet connection, you need to have put in your personal audio PIN, otherwise we'll not be able to unmute you. As a last housekeeping point, note that this webinar is being recorded. And without further ado now, I hope you enjoy this webinar, and I hand over to Eric Usher so that we can start with the webinar. Thank you very much.
Great. Thanks very much, Karine. And hello, everyone. Good morning, good afternoon, good evening. Thank you for joining. I think we're going to have a good discussion. I'm going to give a little bit of a framing opening on where things are at with the initiative and with the paper. And then we're going to pass over to Andrew to go into a lot more detail. And we will have time at the end for feedback and questions. Let me just, in terms of the big picture of the initiative, many of you might know this well, but principle one of the positive impact principle states positive impact finance is that which serves to finance positive impact business. It is that which serves to deliver a positive contribution to one or more of the three pillars of sustainable development once any potential negative impacts to any of the pillars have been duly identified and mitigated. So that's, in many senses, is the framing of the initiative of what we're aiming at. But let me get into a little bit of the historical, and you see on the slide 4 stages of development of the initiative to take us to where we are now. In terms of how the genesis or how it got started, there was initially a group of banks which were later joined by a number of investors, started to think about how can we get into the difficult space of financing sustainable development. Essentially, how can we tackle the question of how to finance what today seems beyond reach of with the sustainable development goals? And in recent years, we've certainly are seeing a lot of progress on sustainable finance broadly, particularly on disclosure, especially through the TCFD framework. So lots of progress there, but we also know that prudent risk management on its own is not going to get capital to all the places it needs to go, and therefore PI is really aiming at that segment. In a second stage, this group put together a manifesto, which essentially is a vision for the initiative that aims to address the challenge that if the SDGs, the Sustainable Development Goals, are to be met, they must attract essentially what will be trillions of dollars of mainstream finance. In short, the unmet needs need to become the source of a profitable market or markets. So the expectation is that by seeking a holistic understanding of the environmental, social, and economic needs around us, new business models can be developed that can help deliver the impacts sought by the SDGs. So we need to understand these impacts better, starting with existing business models to get from a net negative economy to at least net neutral, or maybe somewhat positive economy, and then to work also on really new types of business models that can deliver on the unmet needs of the SDGs, which current business models simply can't address. So with this vision in place, this group of institutions started to work on the principles. And essentially, the positive impact principles are a framework to drive holistic impact management. So to essentially to help financial institutions and some other actors understand and manage the impact of their clients or investee companies, and to institutionalize this understanding across their organizations. And over time, we see these principles as helping create clarity to the market, with their holistic approach and their requirement for transparency. Now, as many of you who have dialed in coming from the banking side will know well, is that we're well in development on principles for responsible banking. And those principles, although still in draft form, has as a first principle that of alignment with society's needs, and as the second principle that of holistically managing impacts. And I think this is critically important, that impact is very, very much lodged at a very high level within that new framework. And the PI principles are essentially a tool for how do you implement on that high level ambition. And a lot of the discussion today really is about how do we get to the deal phase? How do we get transactions moving? How do we set up our institutions in a way that we can identify what will be impact creating business and development? The fourth step, which is shown on the slide here, is really the getting towards the assistance for the how-to. So it's a set of tools that are on development, including an impact radar, which is a tool for impact identification, and also guidance on frameworks for different asset classes and product types. For instance, corporate debt, real estate investment, and another number of others are in development. This guidance is going to allow financial institutions to qualify their products and services as being principles compliant, and for auditors and analysts to start providing verification and second opinions. Can I go to the next slide, please? So, rethinking impact to finance the SDGs. This position paper, which is also being positioned as a call to action, has been prepared to explain the concept of impact-based business models and finance. Now we're hearing, we know it's becoming a noisy space, and there's a lot of talk about impact measurement, attribution, additionality, profitability. But where does impact-based finance come in? Where does it really? What does it mean? What are we really talking about? And this paper essentially is seeking to unpack this concept. At the core is the proposition that the concept of impact can be taken further than we do today. And the strategic opportunity for financiers is to drive their understanding of impacts and make it an integral part of their business development and R&D strategy. It's been prepared by the group of the founders and the current drivers of the initiative. It's based on exchanges with many stakeholders going back a number of years. It's been quite some time in development, really, because it is sort of the positioning document for the overall initiative. So today is an opportunity to understand the conceptual basis of our work on the SDG financing gap. Now, after listening to one of the co-chairs in the initiative, which is Andrew Parry, the head of sustainable investing at Hermes Investment Management, who's really going to present it in depth or in detail, then there's going to be time to provide us some feedback and also to ask questions. So with that, Andrew, thank you very much for taking this on. If I could pass it on to you to get into the details.
Thank you, Eric, and thank you everyone for joining us today on this webinar. The SDGs have become, a popular subject for discussion. They're universally acknowledged, but they also represent this great opportunity to address some of the most pressing needs in global society. But as Eric has just mentioned, they also represent a significant financing burden. And how do we address this? How do we actually mobilize capital to actually flow to where it's needed? I wonder if, Corinne, you could maybe flip the page. Despite this growing enthusiasm for impact and for the SDGs and a very welcome, growing awareness about what they represent, we still are represented with a significant funding shortfall. In the advanced economies, this shortfall is quite modest and manageable, but as you can see from this graph, the gap actually still remains in the emerging world, where institutionally, governance-wise, it is sometimes very hard to actually make money flow. Private financing is constrained by the usual risk and return. Public finance nowadays is also often constrained by scarcity. But as well, the financing gap goes well beyond the concept of financial flows. And really what we're going to explore today is a new paradigm, a new way of thinking about this, that the funding gap is most addressable, not just by flows, but by rethinking our approach through business models and the opportunities that they represent. In many ways, if you look at underserved needs, which the SDGs represent, they do represent a significant future growth opportunity for those with the vision and the innovation to capture them. So it's not just about products and financing, it's about changing and repurposing the way that we think about the opportunities. If we look at Africa alone, where half of the emerging market underserved needs are represented, here we have a population that's growing by 43% between 2015 and 2030. So the fact that the financing gap in Africa is still to be properly addressed just means that time will compound this. So the 1.3 trillion financing gap that we had in 2015, if not met, will actually expand by tenfold because of the cumulative nature of the deficit. So this is not just about an issue today, it's about a cumulative issue going forward. And this is why we're so keen to actually think about ways of addressing it that step out of the normal business as usual and begin to see opportunities to actually really mobilize capital and really mobilize opportunity. So if we could turn to the next slide. Really, the way forward, we believe, for the SDG financing gap is really about putting impact at the heart of business strategy. And really, we see it very much first and foremost as a business model gap. Blended finance and public-private partnership with risk sharing have already been successful and mobilized around about 160 billion of capital. But the reality is that these flows are modest in the context of the missing trillions. And without a new solution, we are very limited in our ability to take the addressing underserved needs forward. Very much, therefore, we see the current challenge is that there is insufficient alignment between the economic sectors and social needs, i.e. there's a big gap between what we would see as investment opportunities and impact opportunities. Now, the way that we can address this increasingly is to recognize that business models are that opportunity. Business models that can increasingly address impact as inherent in their business models and not seeing impact as an externality and a set of risks that need to be managed. The core benefit of this, as we see it, is very much that this is about reducing the overall bill and very much seeing impact as a carrier of financial value. Now, we live in a time of incredible transitions, technology being one, but also we're seeing transitions in geopolitics, we're seeing transitions in the climate and also demographic. And many of these transitions or challenges as well as opportunities, the reason they're challenges is that they actually can end up compounding some of the problems of financing the SDG funding gap. If you think about climate change and its impact not just on business resilience, but also on mass migration, we can begin to see these complex issues that need complex solutions. Now, many people talk about the fourth industrial revolution, the technology-enabled revolution that we're already seeing having its benefit in the developed world with the recognition that sometimes the developing world can leapfrog the business as usual practices of the developed world by adopting new technologies earlier and beginning to see their ability to deliver new services. And very much this seems to be the way forward for the fourth industrial revolution. It's around moving away from a focus on product much more to the service and to the beneficiaries, i.e., where do those underserved needs lie? We see this as an ideal opportunity to put impact very much first and foremost at the heart of business strategies. After all, unmet needs represent a significant emerging growth opportunity that puts the individual needs at the heart of the business model. And if you think about many of the new business models that are growing as we move from the traditional enterprise to a more social enterprise, so we begin to see that technology is a great enabling force to address new markets. And, as the cost, for example, here of data begins to plummet, so we can begin to see that in itself as an opportunity to identify ways of addressing underserved needs more efficiently and more profitably, and to actually expand the range of opportunities, so rethinking business models. We can turn to the next page. Now here we've illustrated with an example of the multi-impact lamppost, and this is actually a very live and real example. But what it shows at one level as well is that the solution to the SDGs, which themselves are complex and integrated, have to be multifaceted. This is the opportunity to actually not just see business delivery as a linear single product, but means that our thinking should be about multi-impact solutions that can repurpose existing business activities in a more sophisticated and more impact-enabled way. I even read this morning that the UK, which is not obviously one of the most underserved needs regions of the world, is actually thinking about using lampposts for electric vehicle charging. It's a simple way of meeting a very underserved requirement that's hampering the development, for example, in Britain, of the expansion of the EV sector. If you think about the deficits in broadband, instead of laying expensive cable and fibre, maybe an option is to use lampposts as relay stations for wireless internet service providers. As somebody who lives in the countryside and who uses such a service, you can begin to see that these are ways of thinking beyond the everyday and repurposing business models. Now, the most important thing about our multi-impact lampposts is that it's really about trying to drive new unified business models where we no longer think of just a single product, but we begin to think reversing back up along the impact chain to try to identify new and emerging business opportunities. And key to this is about enabling the cost to impact ratio to fall significantly. And this is very important because this is a way then of allowing corporates and capital to scale more effectively, because then it gives you more impact alongside a commercial and business imperative. And this is why a lot of our focus is not around products per se, but more about repurposing and thinking about business models and encouraging that adaptive change. If we turn onto our next page, here we took a look at how working backwards, if you like, from identifying the need through the supply chain is another way of driving that reduction of the cost to impact ratio. Here it's thinking about the purpose of reducing energy consumption And then instead of just taking that from the perspective of a service provider who then has to find ways of implementing it, providing incentives that are costly, involved in business plans that maybe need regulatory approval, we can think of it moving back up the service, the value chain, to try to identify all the different stakeholders along the way, where we might end up with one global service provider who provides an integrated service where the impact benefits are part of the reward and incentivization, i.e. the incentivization is the realization of both upstream and downstream impacts and the delivery of the actual efficiency or the tackling of the underserved need. So the great thing about actually rethinking about impact is that we don't have to think of it just as a single point. We can actually benefit and relish from its actual complexity and the breadth that it brings to us. The key is always about seeing impact as core to the business model, as enabling ways of thinking, but also the delivery of new and underserved impacts. It goes beyond just shifting our thinking to recognizing negative impacts, but the realization that the SDGs represent this underserved growth opportunity, and therefore, by thinking beyond that, the traditional, we can actually begin to find new ways of implementing. So if we turn on to our next slide. As Eric has mentioned, very much this is around a more holistic approach to driving impact. It's not about exclusions, not about avoiding things per se, but the move towards to move the entire economy forward. If you like, a system shift. And the only way to achieve this is to minimize or eliminate negative impacts and reinforce and drive forward new positive impacts. What we want to do is change from a net negative impact system to ideally, at the first stage, a net neutral, and then on to a net positive system. And the only way to do this is to go beyond the negatives and begin to recognize that a more holistic way of viewing impacts, to view impact-enabled businesses as businesses that can tap into new, exciting growth opportunities, is really the only way forward. And I think what I've been most encouraged about, both working with the UNEP FI Positive Impact Initiative, but also increasingly working with companies, investors, social enterprises, is there is this recognition of the opportunities represented to rethink business models, to rethink opportunities. Perhaps this is encouraged by a political environment which seems at times to be quite divisive or regressive. I think many companies begin to see their role in the broader economy, their broader role both impacting society and the environment, as a way of actually avoiding fragility, if you like, building in greater resilience into the system, but also recognizing that those underserved needs represented by the growing inequalities across the global economic system also represent a great and emerging growth opportunity. If we see wealth polarize into an ever-diminishing number of hands, what future commerce and business if we're not, if nobody has the means to spend? And therefore, I think we in the initiative have a great opportunity, both as investors, financiers, and advocates, to try to encourage this change in the system, to encourage a more holistic, a more inclusive, but a more optimistic way forward, to develop new business models that, yes, are about addressing some of the more pressing issues in society, but also are about addressing future growth and future return opportunities. We could turn on. So in practice, the finance sector is incredibly well placed to play its role in delivering the three pillars of impact investing. It's not just about economic focus, because economics without environmental and social licenses to operate will count for nothing. But the finance sector is in that unique position because it touches every sector and every economy and every country in the world. It represents a massive opportunity to leverage the system for good, to mobilize capital, to mobilize not just the flow of capital, but to also mobilize and encourage the change in thinking about the opportunities out there. To see the SDGs as the beta of future growth, if you like, to see them as this emerging growth opportunity. We would like to invite you to share with us your thinking on how we can achieve this challenge, and it is a challenge. The numbers that we talked about at the beginning are significant. We have to begin to overcome the inertia of business as usual, and we want to hear from you. We want to hear about the initiatives that are out there. I've been most encouraged, as I said earlier, about the creativity and the innovation that is beginning to come through, and very encouragingly from younger people. I see a very different attitude from the millennials to my generation about embracing opportunities that put social and environmental purpose at the heart of new business models, more social enterprises rather than just financial enterprises. So final chart. So we've today really tried to highlight the high-level opportunities. We try to highlight the taking a new approach to impact, not thinking just on negative impacts as externalities, but seeing the positive opportunities represented by addressing underserved or unmet needs globally. The opportunity to repurpose business models and to encourage a flow of capital to where it's most needed. Now, this is all very high level. The next stage is to go into the detail, into the guidance and tools that will be required for the implementation practically of implementing the principles. So around frameworks to deliver holistic impact assessment and analysis, how to build the frameworks, and to understand what products and services that people would like to see, to understand the impact categories and the opportunities that they represent, and how to monitor, measure, and report on impact, which are some of the trickiest parts, but actually some of the most rewarding, as these really show and illustrate the benefits of actually moving towards a more impactful ecosystem. New business models are all about stimulating demand. They're all about that, the optimism of future growth opportunities that are really driven with impact at its heart. And I think this is, for me, the most exciting opportunity, is actually repurposing the way that we think about businesses. Not for them to necessarily put social or environmental priorities ahead of financial ones. That will never stack, because we need to have financial returns at the heart of this to provide the scale. But to recognize that positive impact can be achieved with attractive long-term financial returns that bring greater resilience, greater opportunity to the global system. So today, we'd like to hear more from you and your ideas on how we can achieve this objective.
Great, thanks. Thank you very much, Andrew, for a very comprehensive presentation. So maybe if I could just say in summary, so what is key here, I think, is that we're looking at positive impacts in a new light. essentially what's their ability to become central to business models and value creation, rather than just simply externalities. So this points to the need for a better, more systematic overall understanding of impacts, which is certainly what the initiative is targeting at, and including particularly through this paper. So thank you, Andrew. I think you've given a good overview of essentially of the initiative and where the paper starts to chisel away at on some of these issues. So maybe if I can open it up, we've received a couple questions. So we will start to go into those, and I think, Corinne, maybe it would be useful also to give a reminder, first off, just in terms of anyone who joined later, what can people do if they want to supply questions?
Sure. So thanks a lot, Andrew and Eric. To submit your questions, you have in your dashboard a little segment that says questions, where you can just type in your question, which we can read out and answer, or you can raise a hand if you want to formulate your question by audio. We'll unmute you in that case.
Okay, thank you, Corinne. Can you read this first question, if you can do that? Is it here?
Sure.
Maybe I start with this one.
Yeah.
Okay, so first question, which is coming from Leah Lasenko. The principles strongly focus on mobilizing capital towards the SDGs and embracing the opportunities. Does this approach explore the application of SDGs to risk management? In other words, sort of identification of potential negative impacts. Andrew?
Yes, it does. I think what we're trying to do is to ensure that we look not just at the risk mitigation, but look also at the positive opportunities that the impact ecosystem provides. Of course, if you don't look at the negatives, for example, whether it be around climate, then it could very well be that you overwhelm any of the other positive impacts that you have if you allow a systemic risk to become so overwhelming that it damages the whole ecosystem. However, impact can't be viewed just as a series of managing negatives, because to move that whole ecosystem to a net positive impact environment does require a focus on new opportunities as well. So I think historically we've tended to think about impact as around risk mitigation. That needs to continue, that needs to become more sophisticated, and it also has to be seen as the other flip side is what are the solutions, so what are the positive impacts to that risk mitigation and the opportunities it represents.
Okay, thank you, Andrew. I'm going to come in, we have a series of questions. Let me come in with the second one, and actually I'll put this one to Corinne from the Secretariat. The question is, how should we be measuring the positive and negative impacts generated by our investments?
Thank you for the question. Indeed, the question of measurement is a central one. And as actually the slide that's still on screen shows, this is one of the areas that we're working on within the initiative in terms of the guidance and the tools that we'll be issuing later this year for the implementation of the principles. There's obviously a lot of techniques and standards and metrics that are already available, and we're not going to be reinventing all of those. What we're trying to do effectively is to provide a framework that would help us understand basically the market in terms of the kind of products and services that we see independently precisely of some of the standards or the frameworks that are being used, so that this can be used as a common language. And when it comes to measurements and monitoring, what we see basically is that there will be in kind of a schematic way three kind of situations depending on effectively the access to data and kind of the position of the issuer relative to those impacts, depending on whether that is close or not. There's of course empirical measurements, but that may or may not always be practicable or feasible. Another approach is that of predictive models that have the advantage of being back testable as well. And then thirdly, where when neither of those may be possible, we may be working off a series of proxies such as taxonomies as well. So within the guidance that we offer in the first instance, it will be to clarify some of those options and to indicate indeed which are the, the frameworks, the taxonomies that exist and that can provide a starting point. So I hope that's a helpful first introduction.
Okay, great. Thanks very much, Corinne. That's a question from Elise Hockley. I'm going to go to the next question, and Andrew, maybe if I can come back to you. And the question is from Jan Reyes. And the question is, how can we connect the approach of positive impact principles to the multi-capital approach of integrated reporting? In other words, positive impact on financial, environmental capital, and also human, social, intellectual, and natural capital. Andrew, can you?
Yeah, no, it's a very important question. And I think it gets to the heart of actually what impact is about when you begin to understand what the nature of capital is, that it is not just about financing, it is about those human and environmental impacts and issues as well. Human capital, I think, is going to be increasingly part of the debate in this fourth industrial revolution, the technology. And I think as we begin to raise questions about what the purpose of companies is and what our social model should be going forward, I think that's where we're going to find a significant amount of debate. I think the repurposing of business models to think about impact is actually is probably the right way to actually join the dots in that area, to recognize that without a recognition of human capital within a technology-enabled environment is to put us in a potentially disruptive and dangerous situation. But also, I think the other challenge is around standardization of language and reporting. It's at the moment it is one of the biggest difficulties that when we come to reporting any of the impacts achieved, that there is no standard measure, there is no standard language, and that it represents danger for either greenwashing, where we end up labeling existing activities without any change, or we have an inadequacy of encouraging people to change their models by an inability to represent the benefits that have been achieved. So I think this is what the Positive Impact Initiative is trying to do, is trying to provide that framework for understanding the impacts that are being achieved right across the capital allocation spectrum, and the role of human and environmental capital plays. So I think it's a way to go. I think we have more work to do in that, and we do need to bring in as many different participants as possible, not to provide convenient labeling, but to provide a way of actually framing our decisions that recognize these complex issues.
Great. Thank you very much, Andrew. I have another little bit longer question from Morgan Mandeville, and I'm going Corinne, if I could ask you to address it. The question is, given that this is a new way of thinking financial institutions, in particular, to what degree will UNEP guidance and tools assist FIs in understanding how to integrate new valuation tools in their traditional business lines? Essentially, before you can measure and monitor, you need to understand what it is you're measuring and monitoring.
Thank you, Eric. Indeed, that is one of the areas that will be covered by the guidance. If I just go back to the previous slide, where you can see guidance and tools that we're working on, kind of separated into two separate steps. So frameworks will really be an area where we provide, let's say, the model frameworks that can be used to have a process for precisely managing impact, all the way from identification to assessment, monitoring. So what does that overall framework look like in a way that is bespoke to different lines of business, different types of products and services relative to different types of underlying assets, acknowledging that the way we implement such impact management cannot be exactly the same depending on the kind of situation we're facing. It's not the same doing this for project finance as it will be for corporate lending, and within corporate lending it won't be the same if it's general purpose where we're the lead arranger or we're not the lead arranger, or if it's something for a specific purpose. So that is what the frameworks are for. In terms of the actual impact analysis, which is part of that overall process, we have effectively identified, obviously, that very separate moments of identification and deeper analysis. And so we're taking this in steps where, for the part of identification, we're working on a tool that effectively tries to collate what the main impact categories are. So if we're saying that we need a holistic approach where we look at not environmental, social, and economic separately, or look at one failing to look at the others, but we want to have an idea of the whole, then what would be the main impact areas or impact categories that enable us to have that holistic view? So this is a piece of work that's in progress at the moment, to identify those main impact categories that enable, which are the first step effectively to enable us to move from what are effectively macroeconomic goals and targets as we understand them sometimes in the SDGs, to something that will be implementable at a microeconomic level in the context of business and financial institutions. So in a way, we look at that as our very initial impact radar, as we're effectively naming this tool, which is not something that means that then we go into an in-depth assessment analysis of every single impact category, but it is a starting point effectively to help us identify which are the significant impacts, both positive and negative, so that appropriate action can then be taken in terms of identifying or better measuring, anticipating what the positive impacts will be, and hence what we will measure and monitor. And on the other hand, what are the negative impacts that we need to be addressing? So that is effectively the first step within impact analysis per se that we're addressing. Following on from that will be effectively further guidance to try and see what are the impact indicators relative to those impact categories that are currently in use. Where do we, where can we basically orient vis-a-vis what's available and how they're relevant to different business lines? Where are there gaps where we might want to work on? And in any of those instances, I think it's very important to highlight that this is going to be always on a collaborative basis with initiatives and with stakeholders that are active in this space. So we're not reinventing things in parallel. We're providing a broader framework that enables to make a sense of the whole, independently of whether we're an investor starting in with a very specific agenda on climate change, or someone with a broad loan portfolio who's at the outset trying to look at what a sustainability outlook might be. So this is not something that tries to recreate something in parallel, but rather creates a common language where everybody can work from what they're using. Thank you.
Thank you very much, Corinne. Okay, thank you. We've quite a few questions. I'm gonna move to the next one. I'm gonna come back to you, Andrew, on this. This question is from Simone Targetti-Ferri, and it's around the notion of when we develop principles for positive impacts, we need to think about different categories of asset owners, and having one set of standardized principles for high level or top and medium scale investors may not be feasible. And so the question is, as you get down, I would say, into the weeds, or starting to get into detailed investments, smaller enterprises or transactions, are these types of principles actually adaptable? Can you scale it down to get into the detailed type of transactions, which you'll never be able to predict a priori in terms of size and shape? So will these principles be able to be applicable to a wide range of transactions? I think scales, but also, for instance, geographies or asset classes. Andrew?
Yeah, so it's an excellent question because it's one of the barriers sometimes towards people, particularly from an investment perspective, thinking about how to tackle investment, where they see it as sometimes being terribly prescriptive or constrained, and that there is only one way that fits all, and that's patently wrong. I think Corinne has just explained that flexibility is, is an important part of what we're trying to do. We do need to have them to be context-based, context not only for the people providing the finance or the investment, but also the context of what you're trying to achieve on the ground, for the beneficiaries. So the context of a philanthropist investing in a health-related project in sub-Saharan Africa might be very different to somebody bringing as an investor solar energy connected to smart grids and the mobile telephony system in Kenya, for example, as opposed to maybe thinking of some of the health benefits from technology advances in the more developed world and how those might then trickle down to the developing world over time. I think it is it's very important to have a framework that allows a common language, but a flexible application that reflects all the actors in this very complex field. So we don't want it to become prescriptive, narrow, and product-led. We want it to be a flexible framework that can be creatively deployed and to encourage additional flow of capital.
Great, thank you, Andrew. I'm going to let me change gears a little bit, and I will come to Corinne with this question, which is from Lawrence Mila de Canal, who asked the questions around, are links being made to science-based targets and or planetary boundaries concepts in the framing of the notion of impact?
Thank you, Eric. Yeah, so I think the place where the science-based targets comes in for what we're describing under the Positive Impact Initiative and some of the tools and specific implementation materials is effectively under, again, the impact assessment. So that once we've been through the identification stage of understanding what are the significant positive and negative impacts, the deeper assessment effectively will need to go into specific areas, specific impact categories where it is anticipated there may be significant impacts. So if we take now positive impacts, which is what we're interested in when you talk about your science-based targets, then the question obviously that becomes raised is, what are the right KPIs? What are the right indicators to use? But also very much linked to that, what are the baselines that apply in terms of from which point do we consider that we're indeed facing positive impacts or negative impact on an impact category? And those baselines do have effectively a measure of contextuality, whereby the answer to that question may not be exactly the same depending on context. So the answer might not be exactly the same if you're effectively working, for instance, from Amsterdam, or if you're working from Nairobi, for instance, on a particular deal. So that's one element. Another element is indeed what might be, specific targets that are in place in your location that you need to align with. So those may actually be in existence and can be worked back from in certain instances, and in others not. So I think this is, another key area of work where the dots need to be connected is indeed, wherever targets are clearly set out, that those be used in establishing indeed those baselines. So that's probably where this element comes in.
Great, thank you very much, Corinne. Andrew, I'm going to come back to you, and this is kind of a bigger picture, maybe Hermes driven, well, a question based on your experience at Hermes. Hermes is pretty advanced in this space generally. And so the question is, just from your experience, what does it take to drive adoption of impact-driven approach in practice?
A very profound question. I think if I put it in the context of how I thought about it when and how we have at Hermes, it's the real way to enshrine it in what you do is to go beyond thinking of it as like a marketing opportunity, a product labeling or badging opportunity, and really try to sort of dig down to the sort of the why question, which leads you to actually really question what the opportunities are. So for us, when we were looking at the whole impact space, one, it was a recognition of all the good work that's been done so far. There's in many ways, impact investing has been in the last decade one of the most innovative areas of finance, led by foundations, I would say, give them their credit, and by a few forward-looking institutions. If you go back even further, you can look at the work of the DFIs as a form of very direct impact, providing direct local infrastructure in some of the poorest parts of the world. Also looking at the rise of the social enterprise, where societal benefits, societal impacts are put alongside business, and where the profits can be reinvested back into improved societal outcomes. When you look at some of the work being done across those areas, you begin to understand what impact is all about. So for me, it was therefore trying to understand in the value chain, who are the beneficiaries and what role were you playing in addressing their needs? And so for me, the way we tackled it in trying to think of the opportunities was to produce our own taxonomy, to recognize the SDGs as a complex opportunity set, but a really interesting one for identifying emerging growth opportunities, and then to see which of the SDGs, not at the goal level, but drilling down to the individual targets, could be addressed in different ways through different asset categories, whether it be in public equities or credit, in private markets, in infrastructure, or indeed through the way that you engage with companies. I think engagement is a very powerful form of impact that all investors, including the very largest passive investors, who can actually bring a form of additionality to their investments by engaging with the thousands of companies in which they otherwise would have no way of adding value, but engaging with them to think more holistically, more broadly about their negative and positive impacts and their role in trying to change them. So for me, having one's own taxonomy about what the opportunities represented in the areas in which you operate, having the integrity to be clear and open about what cannot be done, and recognizing the role of finance in shifting the whole ecosystem. We're not separate from the ecosystem, we are an embedded part of it. And so therefore, it was that recognition of our opportunity, maybe even our responsibility, to actually help shift that to a much more sustainable, net positive system, rather than the net negative one in which we dwell at the moment.
Okay, super. Thank you very much, Andrew. We are getting to the end of the questions. I have two left, and Corinne's going to finish off with some sort of next steps info. But the first question, which is it's a longer question. I've simplified it down, but essentially, and this is for Corinne, how do the PI principles relate to other standards and frameworks that are already out there or in development?
Indeed, this is an important question because we are at a time where there are multiple frameworks, initiatives, standards that are emerging, and the terminology will tend to repeat itself. And so, as mentioned earlier, the initiative and in particular the principles are not creating a parallel standard or a parallel framework, so to speak. I think it's important firstly to just remember, let's say the outset and the purpose for the initiative, which is really this notion of homing in on the financing gap, and where as we've been exposing in the webinar today, the underlying proposition is this notion that we need to think about impact even more deeply, and that it can do more for us than we perhaps think it originally thought, in the sense that it can be this driver of value creation, of new cash flows, as opposed to something which is just something we need to drive to increase positive impact by integrating negative externalities and better measurement, but that there's actually an even I would say deeper stimulus that can be achieved by an understanding of impact, and it's that point that really is supposed to make a step change in terms of addressing the SDG financing gap, which is not quite the same as saying understanding our contribution to the SDGs. It's about what do we put in place that will help us actually address the financing gap, and where the answer is, well, on the one hand, in terms of the business models that exist, indeed we can push them towards more positive impact, but also there are radically new and disruptive business models that are in the making, or that we can help to bring about if we understand market players and their potential to do so, and if we can engage with them and provide also the financial mechanisms whereby to do that. Going back to that lamppost example, a key point of that is not, is that it's not just down to the technical multi-solutions, it's also down to the fact that those multiple impacts and services that are being provided would be financed differently. Rather than being financed just on counterparty risks, they're being financed on different contract services. The implications of that are quite profound, in the sense that, specifically in terms of emerging market or developing country context, where country risk and currency risk are always major challenges, this kind of approach can diffuse some of those risks and open up our opportunities. That kind of approach also talks to scale, because by definition, if you're looking at multi-impact, you're going to be promoting programs that are on a much bigger scale from the outset. So you're thinking big from the start. So I think this is one thing, sorry for going on a little bit, that really is fundamental in terms of the initiative. It's about, putting a framework up that is specifically aimed at enabling us to resolve that financing gap, and to think of that in terms of, new business models and improving current business models. In terms of then the way forward on that, and the processes and tools and things that would change within financial institutions in terms of their analyses and how their procedures work. Here, with the overall framework that we have with the positive impact principles, as said, the idea is to provide a bit of an umbrella framework, which is one that you can use in addition to basically whatever is already in use. So there might be the green bonds framework, you might be working back from the impact management projects framework, you might be using other frameworks and standards. All of those will basically be constitutive of part of what is being suggested on the positive impact principles. So the idea is, independently of the framework or the analysis that you're using, this umbrella framework enables you basically to provide clarity and comparability across different frameworks. That was one thing. And the other is, effectively, it enables us to fill in some gaps, because if you look at current frameworks and standards and procedures, you will find that they will tend to be focusing either on a particular theme, such as climate change, or more broadly green, or they might be looking in from a particular segment of the industry, either the investment industry or from very specific products such as bonds. And so here the idea is, with an overarching set of principles, you can go across those different audiences, but also you're ensuring basically that, any gaps in terms of the other areas of sustainable development, so the three dimensions basically of economic, social, and environmental are covered, thanks also to this positive negative approach. So that is effectively how the two can complement each other. And in terms of some of those other initiatives, we're actually we have been since the beginning of the elaboration of the principles, exchanging with them as we prepare the guidance and as we issue the information. So that is as the model frameworks and as the impact radar become available, there will be multiple references and clarifications of to these other standards and where they basically are usable and what are basically the additional steps or elements that one might want to consider for PI compliance.
Thank you, Corinne. Thank you. And we need to finish up fairly soon. That question I didn't mention earlier is from Bruno Bissek. So thank you, Bruno. We have, and Corinne has referred to this a little bit, the notion, but Tony Lee Yun Len has put forward a question, which, Andrew, maybe I come to you. It might be a little bit similar to Corinne's response, is basically the question around putting monetary value on externalities. And, can we put a value on the negative impact reduction, like for instance, the carbon market, or rewarding positive impact, like, for instance, social impact bonds? Is this a way essentially to put in the economic equation of the investment, to put impact in the equation? Andrew, what are your views on that?
I can understand the enthusiasm for trying to find a way to do this. And in certain circumstances, in certain sectors and opportunities, there is undoubtedly a way of doing it. I think more broadly, it's not as easy as it seems, which is maybe why we like to take a more holistic approach and recognize that there is a benefit, even if it's hard to put a precise monetary value on it. I think part of the difficulty, particularly in the mainstream investment world, in valuing impact, is comparison across sector, regions, and activities. So what represents a quality job in Detroit, Doncaster, Dakar, or Delhi? There is a need for quality jobs in all four cities, but actually what represents a quality job will actually have a different monetary value. I've seen people trying to put monetary value on increased life expectancy, and while I know that many World Bank agencies have looked at issues like that, actually then directly attributing it to the activities of companies, I think could end up being somewhat misleading, and there is a danger of overclaiming or false claiming. A lot of the way that I focus on the benefits of impact and the impacts that are being achieved is to start first and foremost with the purpose and the narrative of the impact. And I think there's sometimes that when you try to monetize or put a number on something, that it gives some notion of precision that actually isn't there. And also it fails to recognize the complex interactions right across an entire value chain, some of which are going to be negative as well as positive. And I do find that people have a habit when they're looking at a company with impactful activities to only focus on the positives and fail then to net off any of the negatives. So yes, let's think more about how we can actually quantify the benefits and frame them in a way that recognizes they have an economic value, but let's not get overly driven by the number itself, because I think it might end up having some unintended consequences.
Okay, thank you, Andrew. And obviously, many of these questions are the basis for much longer discussions, and where lots of viewpoints are needed, and probably there are never, it's not never white and black or hard, fast rules. It's all about, I think, learning from each other and trying to figure out for each organization which is the type of approach that is most suitable. I think, unfortunately, we do have to cut off for time, but if anyone has asked questions and hasn't gotten an answer or has other questions, I would ask you to please get in touch with Corinne and her team in the Secretariat, and we endeavor to provide more feedback, but also it helps us form the types of activities, the guidance notes, and the tools that are being developed, and including particularly this paper. So with that, I would like to hand it back to Corinne, and she's going to just run through a couple more slides in terms of what the next steps are. Corinne?
Thanks. Yeah, so this webinar, as mentioned, was really to take sufficient time to look at the concepts of impact-based business models and finance, and looking at impact as that fundamental value driver. Through the questions, we've looked a little bit more and discussed quite a bit on things that have to do with implementation, but we do actually want to give the benefit of a full webinar to explain a bit more about the principles, the different model frameworks that we're developing, the impact radar, etc. So do stay tuned for an invitation and an announcement of a second webinar where we go more into those issues in October, most likely in the second half of October. In terms of the position paper itself and those guidance notes and tools, those will be released, the final versions of those will be released in November at Unify's Global Roundtable. Many of you probably already know that's happening from the 26th to the 28th of November in Paris. Other than that, you can receive positive impact updates by signing up online, where you'll get updates in real time. In the meantime, the more feedback, the better, in terms of us consolidating not only the paper, but also working on the first tools and the first guidance notes. The consultation in terms of the position paper itself is open until 15th of September. You can find the paper, but also a feedback form online. You have the link there on your screens. If you haven't already read the paper as a whole, please do take a look. And if you have a few minutes to spare, you can use an online form to provide feedback, although we're more than happy to receive feedback by email or even a phone call, whichever works best for you. Just also to mention that you have a hashtag there if you want to follow what's going on via Twitter. And the position paper can also be shared by LinkedIn, depending on what might be more convenient for you. So those are some of the next steps. We do hope to have a lot of feedback from you, and also to have you participate in the next steps of constituting some of our tools. Thank you for your attention. You can also, as we were saying earlier on, just contact us directly. You should see on your screens here quite a few options to get in touch with us, so please don't hesitate.
Great. Thank you very much, Corinne. Thank you, Andrew, and thank you everyone for listening in and sending your questions. And we look forward to continued engagement as this initiative grows. Thank you.
Thank you.